Hi, this is PR Sundar. Welcome to this special episode of 2023 series. I came out with one video, what happened last year, the second video, what can happen this year, and third, which sectors to focus on this year. And now, in the video which I mentioned in 23 target, I mostly discussed about the international events, and also as long as there is no big negative news from the local side, our markets are likely to perform very well. Remember in 2018 in the budget, the long-term capital gain tax was introduced. So that particular year we did not do well. A budget, in fact, many years before, the budget is a make or break thing. The most important event to watch in a year is a budget. But nowadays, mostly the budget, is just a submission of a statement of accounts. And because, 99% of the things are already done outside the budget. And in fact, increasing, decreasing the indirect taxes, it all lies with the GST Council. So, not much. But however, there can be some policy changes that can impact the stock market very much. So, one such example was 2018 long-term capital gain tax. Today, there is a very strong rumor going around, and let me put it in a funny way. So, I have a good news for you and I have a bad news for you. So, which one you want first? The good news is that the long-term capital gain tax may go away. Don't be happy so soon. The bad news is that the long-term capital gain tax will be removed, but whatever the profit you are making, that will be clubbed into your income. And most of the people pay 30% along with the surcharge, about 35% taxes in India. So if the long-term capital gain tax is removed and if the profit is considered as your income and it is taxed accordingly, then instead of 10% capital gain tax, you will end up paying 35% capital gain tax. This is just a rumor. The markets always react for the rumors, and probably that is one of the reasons why in the first week of January, India is the worst performing stock market in the world. Except India, all other markets are in green in January. This video is being shot on 7th of January. As of now, Indian markets are in red. Two rumors are floating around. Number one, when it comes to investment in stock market, so if it is less than 1 year, your profit is considered as a short-term capital gain tax. Short-term capital gain, it will be taxed accordingly. And if you hold the shares for more than 1 year and if you sell it and make a profit, then it is considered as a long-term capital gain. This short-term, long-term is 1 year, is only for stock market. You get out of the stock market, you go to the real estate or some other things. So it's usually 3 years. You buy a real estate, you sell it, make a profit, and if you do it before 3 years, it's a short-term capital gain. After 3 years, it is long-term capital gain. So now some people say the government is thinking of bringing uniformity across all asset classes. So then the long-term capital gain will be, if you hold the shares for more than 3 years. So even if that comes also, it's going to be very bad for the market. I would say this is the biggest risk for our Indian stock market in this calendar year. So second one, as I told you, the long-term capital gain or short-term capital gain, everything will be removed, and whatever money you are making in stock market, it will be considered as your business income and it has to be taxed accordingly. This is just a rumor, but again, operationally there are few difficulties. Say for example, take FIIs. So FIIs, when they do trading in India, when they invest in cash market, so when they make a profit, they are liable to pay a long-term capital gain tax or short-term capital gain tax. However, if they are doing trading in futures and options market, and the futures and options market is considered as a business because of double taxation avoidance treaty, So those FIAs who are doing business in India, so they don't pay tax to Indian government. So if FIA doing a business in India, they have to pay no tax. But if they invest long-term or short-term capital gain tax, they have to pay. So now, if this long-term, short-term capital gain tax are abolished, everything is considered as a business income, then the government of India will be collecting more tax from Indian tax residents, whereas they will lose money. The FIAs will not be liable to pay tax to Indian government. So there is a technical problem. So how they are going to handle it, we do not know. The very first thing that whether this is in the pipeline or not, that also we don't know. This is just a rumor. But if that happens, I would say you just go and look back at 2018, what has happened. That is likely to happen in this coming year. At a time when US problems are getting lower, European problems are getting lower, China problems are getting lower, and then we may have a big problem. So if this happens, and not only that, so there is another bigger rumor actually, but even the people who are saying that it may not come this year, so this may come maybe in 2025 if BJP is re-elected for the third term in 2024. That's called inheritance tax. Just to explain to the people who don't understand what is inheritance tax, okay, so I'm making money, I'm paying taxes. After paying taxes, I'm buying a property. After I die, where does that property goes? So that property goes to my son. Inheritance tax means my son is not making any money. This property he is receiving at free of cost from me. So that property's valuation will be considered as his income and he will have to pay tax. And just give an example. So if I buy properties worth 1000 crore and then if I die, then if that 1000 crore property goes to my son, so 1000 crore will be considered as my son's income and he is liable to pay 350 crore tax. So where will he go for 350 crore cash to pay the tax? So he will have to sell 35% of the assets in order to pay the tax. And believe me, this inheritance tax is there in US. But you know why most of the countries they do this? You will be surprised to know even in India, the personal income tax, it can go as high as 42%, whereas corporate tax, is maximum is 27%. 22% plus surcharge of 3% plus 2% CSR, including everything, will be only 27%. So why the corporate tax is much lower than the individual tax? The reason is very simple. In a corporate, everything is publicly available information and everything trail will be there. We cannot take money from somebody, we cannot give money to somebody. So it has to go through auditing. So auditor will ask question. So it's more like a formalized economy. And in individual, somebody can make some business, can make some profit, but he may not declare that to the income tax. So all those kind of things can happen. So that is why all over the world, the corporate taxes are much lower than the individual taxes. If this passing of the property or any other asset, if that is considered as a income for my son, then what most of the people will tend to do, instead of buying the property and other assets in their own name, so they will float a company and they will do it in that. So if I have a company, and if my company there is a 1000 crore assets, so after I die, what happens? I resign as a director from the company, my son becomes the director of that company. One board resolution is enough. Then he does not have to pay 350 crore taxes. So this will indirectly force the people to bring everything under company, and everything comes under company. Everything, the trail is there. Everything public information is available. So everything trail is there. So auditor will question everything. So that will become like informal economy can become formal economy. So I really don't know what I'm doing. Probably the finance minister did not thought of all these things. Now I'm giving her the clue. I'm giving her the advantages of doing this. So she may soon do this one in the next budget. So let us hope this does not happen. And because the Indians are very, very sensitive. Other countries like US, there is an inheritance tax, but their children life is more or less safe. The government takes care. But here why we save more, why we buy property more, why we buy gold more, why we buy shares more? Because like we feel that our children's future are not secured. They need a fallback. So that is why we do it. So without corresponding social security and without corresponding opportunities for everyone to grow, and this kind of taxes will be very, very bad. Just to summarize, so any tinkering in long-term capital gain tax or any tinkering in wealth tax or inheritance tax will be the biggest risk for our markets in the coming years. So hope you enjoyed watching this video. Thank you for watching.